Module Overview. Investment decisions are rarely made under conditions of certainty. Whether it's a factory expansion, a tech startup, or a multinational joint venture, the future is unknown and outcomes are subject to risk and uncertainty. This module explores how to identify, measure, and incorporate risk in capital budgeting decisions. It discusses the difference between risk and uncertainty, various quantitative and qualitative techniques for evaluating risk, and how to adjust project appraisals based on risk perceptions. You will learn how to use tools like sensitivity analysis, scenario analysis, simulation, risk-adjusted discount rates, and certainty equivalence to account for the unpredictable nature of business environments. Understanding risk versus uncertainty. Risk. When outcomes are unknown but probabilities are known, e.g., coin toss, stock volatility. Uncertainty. When outcomes and probabilities are unknown, e.g., new political regime, unexpected regulation. In capital budgeting, risk refers to the possibility that actual returns may differ from expected returns. Sources of risk in capital budgeting, DECON. Market risk, changes in market demand, interest rates, inflation. Operational risk, production delays, cost overruns, resource shortages. Regulatory, legal risk, changes in tax policies, environmental laws. Political risk, especially in foreign investments, includes expropriation, currency controls, technological risk, obsolescence or disruption by innovation. Competitive risk, new entrants, aggressive pricing from competitors. Financial risk, credit access, exchange rate fluctuations. Techniques of risk analysis. Capital budgeting decisions must account for these uncertainties to avoid misleading conclusions. 1. Sensitivity analysis examines how sensitive NPV or IRR is to changes in one variable at a time, e.g., sales volume, cost of capital, variable cost unit. Answers. What if sales drop by 10%? Identifies most sensitive variables, those with highest NPV fluctuation. Example. If a 5% drop in sales causes a 30% drop in NPV, sales are highly sensitive. 2. Scenario analysis examines the combined effect of multiple variables changing at once. Constructs best case, base case, and worst case scenarios, provides a range of possible NPVs. Example, best case, high demand, low costs, NPV, 1.2. Base case, expected values, NPV, 600K. Worst case, low demand, high cost, NPV, 100K. 3. Simulation analysis, Monte Carlo simulation, simulates thousands of possible outcomes using probability distributions for key variables. Risk and portfolio theory. If a firm is diversified, it may accept some unsystematic risks. Projects should be evaluated for their contribution to firm risk, not in isolation. Systematic risk, market risk, is considered in the KPM model. Untaxed, cost of equity, SAS, RF plus Ambeta, RM, RF. Risk in foreign projects. Foreign investments involve exchange rate risk, political risk, tax differentials, transfer risk, repatriation restrictions. Must adjust expected cash flows, possibly with country risk premiums. Limitations of risk analysis techniques. Method. Limitation sensitivity. 1. Variable at a time assumes independence. Scenario limited to discrete scenarios. Simulation requires complex modeling and computing. RIDIA risk premium is subjective. Certainty equivalent. Difficult to estimate A values. Decision trees becomes complicated with many stages. Summary of module. Risk is inseparable from investment analysis. By using a combination of quantitative and qualitative tools, decision makers can understand risk exposure, prepare for uncertainties, avoid over-optimism, make informed decisions. Risk analysis does not eliminate risk, but it ensures risks are consciously and systematically considered.